Hi everyone, and welcome back to Frank Wealth Insights. I'm Frank Fantozzi, President and founder of Return on Life Wealth Partners. Today we're diving into real estate, not just the roof over your head, but as an important tool investors use to diversify their portfolios, generate income, and plan strategically. So why do we talk to real estate so often with families and business owners who we work with? Because it's one of the few asset classes that offer three distinct characteristics: current income, long-term appreciation, and unique tax planning opportunities. But before we jump in, just a reminder, the information in this episode is for general education purposes only. It is not personalized financial, tax, or legal advice, and please consult your own advisors before making any important decisions. Also, investing in real estate, like other investments, involve risks, including market fluctuations, property-specific issues, and limited liquidity. Any forward-looking statements or references to potential outcomes are based on assumptions and estimates and are subject to change. And as always, past performance is not indicative of future results. So with real estate, there are definitely some core types of real estates we need to consider. When most people think of real estate, they picture buying a rental home, a vacation property. That's most familiar entry point for them. But there's a broader spectrum of residential, commercial, and institutional vehicles like REITs. So let's start with residential real estate. Those are examples would be like single family rentals, vacation rentals, and small family multi-unit facilities. The pros with residential real estate are the fact that investors are familiar, they're accessible, there's steady housing demand, potential lifestyle benefit if you're looking at vacation properties because you can personally use the property. However, there are some cons. Okay, there's tenant turnover. It's always a pain in the neck when you have to worry about releasing a space. You have to get the space ready, cleaned up, and redone. There's ongoing maintenance costs, property taxes, and local market dependency depending on what's happening in the local area. And most importantly, you have to manage the property. So there's an active management part to your involvement. You know, from a bank perspective, banks like residential because it's familiar and often backed by Fannie Mae and Freddie Mac standards, but they usually want from you as an investor 20 to 25% down payment for the investment property. Rent coverage ratios include 125 to 130% of the mortgage, and they really look at the borrower with strong credit reserves. Historically, these type of investments range in the 8-9% area, but again, it's very local dependent. So a second area of real estate that investors can look at is commercial real estate. Examples would be office buildings, warehouses, retail, mixed use. The pros: higher income potential, longer leases, inflation protection through rent escalators that are built into the lease. However, the cons would be bigger capital requirements, vacancy risk, sector shifts. I mean, think about what's happened since COVID. We have remote work and e-commerce that's put pressure, especially on traditional office space. From a bank's perspective, lenders focus more on the property's cash flow. So cash flow is king here. And they're usually higher equity contributions from an investor, upward in the range of 25 to 35%. They also have a ratio they look at called the debt service coverage ratio, which is usually about 125% of the debt service. So there needs to be enough cash flow so that they feel safe that you can cover the debt repayments. Other issues that you need to look at are tenant quality and lease length. A national chain on a 10-year lease is golden. However, if you have a startup company on a 3-year lease, that looks risky. So when a bank looks at pricing and financing a warehouse, or they look at an office building, one of the things they really do look at is lease length because they feel it's less risky, less turnover, less chances for ongoing vacancy. Historically, the returns are going to be a little higher. If you're really running a fully leased building, you should be in the 10 to 12% range. Another area that we like to look at when you want access to real estate and maybe you don't want to manage it directly like with commercial space or residential properties is to look at real estate investment trusts and other alternatives. So they have a category called public REITs. Easy to buy and sell, they're highly liquid, you get instant diversification. Usually your rates of return are going to be around 8 to 9% annually. Part of that is these type of investments tend to behave a little more like stock than a pure real estate play. but for the fact that you have instant pricing, market valuation, and liquidity, there's that trade-off. Private REITs are less correlated in the markets. They behave more like true real estate. There's slightly higher fees. There's a little bit more limited transparency and illiquidity, but you're really buying into a group with other investors, which really leads us to the next category, which is direct subscription and syndication pool. Basically, you pool your money with other investors into larger deals, whether they be apartment complexes and industrial parks. The benefit to this is you have access to bigger institutional assets. You'll have any pass-through from tax benefits, and you have professional money management, which then, there's a cost to that. But again, given the complexity of the real estate deal, it's not something usually the average investor wants to deal with. Cons, your money tends to be locked up 5 to 10 years, and you're really relying on the sponsor's skill and potential ability to manage the building. One of the risks is what they call capital calls. So if there's money that's needed to advance the investment or do an improvement, they're going to ask all the investors basically through a capital call to contribute money. Now, if you don't, usually you're not legally obligated to, but if other investors put money in, your original ownership interest can be diluted. So the bottom line is these are good investments for people that want exposure to the investment world without the headaches of tenants and management, and you basically are trading control for convenience. So the next area I'd like to talk about really is real estate versus other asset classes. So why are we looking at real estate? Real estate falls in this category called alternative investment assets. So you figure, most investors are looking at stocks, and stocks tend to be, if you're fully invested, in the 9 to 10% range historically. There's a little more volatility. There's no guaranteed income, but you have liquidity. Bonds, on the other hand, are a little more conservative. Their rates of return reflect that in the 4 to 6% range. You have stability, lower growth, and you do have what they call inflation risk. Where real estate, depending on the type of real estate you're investing in, you could be in the 8 to 12% range, or even higher if you're really investing in a high growth area. The key thing with real estate is you're buying current income and appreciation. So there's a natural inflation hedge that's built into real estate. So it's not saying real estate is better than stocks or better than bonds, but when you're trying to create diversification and lower risk, using multiple asset classes will really diversify your risk. So real estate is something that investors use to diversify that risk. So another key factor, though, is banks are willing to lend against real estate differently than stocks and bonds. So with stocks and bonds, if they're liquid investments, you can collateralize the portfolio, but you're only lending in the range of 60 to 65% of the fair market value of that portfolio. And there are risks because if you're taking money out of the account, or if there's a drop in value, there could be a change in how much you can collateralize against that portfolio. With real estate, you can usually lend at a higher level, and you don't have the change fluctuations that you can have with collateralized loans against your stock and bond portfolio. So let's talk about tax advantages next. This is a key area with investing in real estate, and it's really unique compared to investing in traditional stocks and bonds. So taxes are really one of the biggest reasons investors love real estate. So one of the biggest write-offs right off the gate is depreciation. So it's not on the land, it's usually on the building, but you can deduct a portion of the property's value each year, even if the market price is rising. Now, there's a trade-off, because eventually if you ever sell the building, any depreciation that you've taken has to be realized as ordinary income if you sell the building later, unless you do something like a 1031 exchange, which we'll talk about in a second. Another thing with real estate is you can expense write-offs. Your mortgage interest, property taxes, repairs, maintenance fees. These are things you can do. You can't, for example, on your stock and bond portfolio, write off your advisor's cost to manage the portfolio. You can't deduct the management fees inside of a mutual fund. So there's a strategic benefit to using real estate because of depreciation. Another really key benefit to real estate is what they call a 1031 tax exchange. It's an efficient way that if you want to buy another real estate deal and you have all this pent-up gain inside of your current deal and you want to stay invested, you can roll the profits into another property and defer the capital gains. And I want to stress defer. At some point, Uncle Sam wants to get paid. But the fact is, you can hold off Uncle Sam by rolling your deal into another deal and stay invested in real estate to make that work. And a lot of people will actually, from a long-term standpoint, if you actually die with the real estate, you get what they call a step-up in basis, just like you do with stocks and bonds on the death of the owner of the assets. And then all these capital gains go away. So the ability to continue to defer capital gains if you want to stay invested in real estate is allowable through a 1031 exchange. And there's hoops and loopholes that you have to go through to make that work, which is beyond the scope of what we have today. But just to be aware that if you have real estate and you're saying, yeah, listen, I want to buy another deal, and if you're looking to and you're willing to sell the current deal that you have, you can defer the capital gains. From an estate planning standpoint, I mentioned the step up in basis. Another benefit to real estate, because usually real estate is owned in some form of entity for asset protection, you can usually discount the lack of marketability or minority interest to reduce your estate taxes through gifting strategies. So these strategies, though, require very good record keeping and guidance. The IRS rules are not easy in this area, so you need to really work with your CPA on this point. So let's talk about financing leverage, because leverage is powerful and it's something that you can do with real estate. Again, that's kind of unique to real estate. One of the things is the pro is you can use debt to buy. So usually most people are buying 100% of the real estate for cash down. You're usually putting 20, 30, 40, 50% down on the deal. So in this case, if you put $500,000 down on $1 million property, and if it appreciates by 10%, you're getting a 10% gain on the $1 million property, even though you've only put $500,000 down. So that, in effect, will magnify your rate of return. But the con or the negative is the same is true on the downside. If you have vacancies or a negative rate of return, your leverage, your financing, will actually turn against you and basically magnify the loss on your portfolio. So again, what do banks care most about? Well, number one, they're always going to look at the credit worthiness of the borrower. And in many cases, especially today's world, they're going to ask you to sign personally on any deal. So if the deal can't work on its own and they need money to keep the deal afloat, they're going to look to each of the individual investors to kick in. Another item we mentioned earlier is the size of the down payment. Typically with residential, you're looking at 20 to 25%. Commercial, you're looking at 25 to 35%. Again, they're looking at DSCR, that ratio, to make sure that there's enough income to comfortably cover the debt. Okay, this is not something that they're going to hedge on. Banks do not want to own your real estate. So even though they can take over if you fail to make payments, the bank is in the banking business. They're not in the real estate business. So they're going to make sure that everything's very conservatively done so that even if there's a vacancy and you're assuming you're at 90% right now and you fall to 70%, that the building can make sure they can comfortably cover the debt service. So they're going to look at stress testing the deal to make sure that it's not too risky, because we don't live in a perfect world and deals don't go perfectly all the time. Appraisals and market comparabilities are going to be important. And then the reserves. Banks often want cash reserves equal to several months of payments. So when you do a deal with a bank, even if it's a different bank than you normally bank at, they're going to have you open up an account and make sure that you have deposits with that institution. So if there is a shortfall, that there's money there to keep everything current with the debt servicing. So if you're serious about investing, learn to think like a banker. You have to approach it from their standpoint because you're asking them for money, right? Think about if your friend comes and asks you for money. Yes, out of your friendship, you might have a bleeding heart. You might want to offer them money. But if you know you're dealing with someone who's not very stable, can barely keep a job, are you looking to lend your friend money? So now the banker is in business. They have shareholders and other, all their customers to be responsible for. So the bank is going to take this very seriously and look at making sure that you have stable income streams, that your leverage, whatever it is conservative, and that the assumptions used when you go to sell the deal to the bank and you go to ask them for a loan, that the assumptions are very realistic. Another part that we always have to look at, and again, this is in common when you invest in stocks and bonds, is you need to do your due diligence and you need to understand the risk. Every investment has to be understood, and you need to understand the risk of such investments. So regardless if it's stocks, bonds, or real estate or anything else, you need to take a look at it. Now, what's unique about real estate? Well, location, location, location. Location is king, because you need to be forward-looking and saying, okay, is this area continually going to thrive? It might be really busy. Say you're buying a commercial space and it's in a happening part of town, and you have comfort that there's going to be a lot of demand. Well, will that demand be there 10 years from now? Will the demographic shift? Will another area of the city become more popular, and then your location becomes less desirable? So locations needs to be really factored in your analysis, because if you have a great location, you're going to be able to demand more from a rental standpoint, and your vacancies will be minimized. So location, location, location matters. So do your homework there. Market volatility. Real estate is much less liquid, and it's not immune to market turndowns, as we learned from 2008 when we had the Great Recession. So real estate is just as susceptible to market dips, maybe not in the same format. It's usually a lagging indicator to market conditions, because you have people on the hook with leases. But then when those leases term out, the question is, where does the economy stand? Where does the demand stand for your real estate? Tenant risk, again, vacancies, defaults, even regulatory changes like in rent control in certain cities like New York. But vacancies, you try to keep to a minimum. So longer leases and incentivizing your tenants to stay longer is very, very important. So making sure your lease contracts are strong so that you can't be taken advantage of by tenants. So that's going to be also dependent on the type of real estate you actually invest in. Liquidity, you have to understand, unless you want a fire sale, that you usually can't sell a building overnight. Where a stock and a bond, you can call in your advisor, liquidate that day, and have the money in your pocket within 3 to 5 days. Here, you have to list the building, you have to sell it. It takes time, and if you need money, it could be an issue. But if you're not, and typically when we talk to investors, you're not going to overinvest in real estate unless you're in the real estate business and your business is to buy and sell and hold real estate so that it is a full-time profession. That's not what we're really talking about here. But anytime you're using what they call limited liquidity investments like real estate or private equity or private debt, they shouldn't normally take a large position in your overall portfolio. So if you need money, you have your stocks and bonds to pull money from, and very rarely do you need to dip that far deeply into your portfolio to have to liquidate real estate or other limited liquidity investments because you're in a pinch. But you still have to be mindful that real estate has limited liquidity. And then management, especially if you're a direct owner, you are the manager. That is your job. Now, if you hire a management company, that's going to go against your rate of return, and you can shift the management headaches to a management company. But you still have to deal with tenants. You have repairs. You have legal issues. You have to deal with insurance coverages, and you have to deal with upkeep, especially with major improvements. And so when you evaluate real estate from an investment standpoint, one of the things you look at is the maintenance log of the building. How old is the roof? How old is the HVAC? These are big ticket items. Imagine what it costs to put a roof on a house, and then think about a large apartment complex. So the costs and numbers are much, much bigger. So these are things that you need to keep in mind, because they eat away at your rate of return. And again, from a cost standpoint, if you are not cash flowing well and these big expenses hit, it becomes a problem. So a lot of times we ask our clients, when they invest directly in the real estate, is that they keep a little bit of a slush fund. Some of the rental money that they make, they don't pay it all out. They keep it in a slush fund for future repairs, because you're going to have them, and there's no way around that. So the bottom line is, do your homework. Just don't jump in because it sounds sexy to own real estate. you make sure you dot your I's and cross your T's and do your due diligence, because if you don't, it's going to cost you in the long run. And let's again reflect on alternate ways to direct investing in real estate. We mentioned earlier about public REITs, private REITs, and syndication funds. Again, public REITs are nice in the fact that they give you access to that real estate field, no management, high liquidity. Again, probably the concern we have is REITs can start to behave, public REITs can start to behave like stocks. So you don't get that diversification factor as you do with direct ownership. Private REITs are a little more beneficial. These are limited liquidity. They're slightly higher fees because you're paying for these ongoing management, but you're diversified further. And again, you're buying real estate more directly through a group. And it's similar to, again, syndication funds. You have access to institutional assets, larger assets that you probably couldn't buy on your own. You get the same tax benefits of other real estate investing. But again, your money's going to be tied up for several years. And depending on the sponsor's execution, it's going to be different in regards to the type of income you need, possible capital calls, and if you want to get out, depending on the agreement structure, it might make it a little more difficult to get out based on the fact that it's a limited liquidity investment. So really what you're looking at is trade-offs here. Do you want direct ownership, gives you control and tax efficiency, but more work for you? Or do you want indirect control through these REITs and syndication funds? You get convenience, but less control. So again, it's going to be your personal decision, working with your advisor to determine what's best for your investment portfolio, which is a great segue into portfolio integration and exit strategy. So where does real estate fit into the big picture? We really believe real estate is a strong holding and should be part of most clients' investment portfolios. It usually is not a core investment like the majority of all your assets would be, like your stocks and bonds, only because I'm assuming here you're not in the real estate business where you're buying and holding and managed properties as a going concern. So typically it's a satellite holding. It's going to represent a minority, basically a minority position or percentage in the overall portfolio, but you need to hold enough to have an effect to diversify. So in other words, if you have a $10 million portfolio and you're going to say, well, I'm going to buy $50,000 of a real estate investment, that real estate, while you're investing in it, isn't going to have enough mass to really have an impact on diversification and mitigating risk. So typically, when you're looking at real estate holdings, you're probably going to look at more of a 5 to 10% position to start to really earn the benefits of real estate. And not that you can't go higher, it's just you're going to balance that with your liquidity needs, the concerns that were raised earlier about investing in real estate, and your overall financial goal. Again, one of the nice things about real estate we mentioned earlier is it provides can provide a steady retirement income stream, and also has inflation protection, because real estate usually appreciates with general inflation. And if you have certain types of real estate ownership that has inflation escalators or cost of living escalators built into the lease, your rents are going to automatically go up. And then from an exit strategy, again, you could do an outright sale depending on the type of real estate you own, direct ownership versus through a REIT. But understand there's a timeline to execute that. But there's also the 1031 exchange we mentioned earlier. If you're looking to stay in real estate and you found a better real estate deal and you want to use your real estate to invest in that bigger real estate deal, you can defer gains through a 1031 exchange. And the government really is in particular in regards to the type of real estate. So you can invest in a multifamily home and then go to a warehouse. That's going to be fine. But it's got to be real estate for real estate. Before you invest, think ahead about your exit plan and make sure that you can feel comfortable with the type of exit strategy you're going to use if and when you choose to get out of that real estate investment. So let's wrap it up. Always with any type of investments, clarify your goals. What is your income need? What is your growth need? Are you looking for tax benefits? And what level of diversification is your portfolio going to require? Decide on your level of involvement. Do you want to be the landlord and be hands-on and deal with how the radiator broke in the old building, or the hot water tank has a leak and you got to deal with that? Or do you want to pass that on to a management company, or do you want to even be more of a passive investor like using a REIT? Run the numbers and stress test it, because everyone always looks at the best case scenario. You have to be willing to live with, a stress test of a worst case scenario. Can you manage that? Can you handle that? So ROI matters, cash on cash matters. Look at your internal rate of return and the tax impact. And again, stress test. Look at vacancies, change the vacancy rate. What does that do to your debt service? What happens if there's pressure on the rates that you're charging per square foot or per unit? What other market downturns can negatively impact? I remember in Cleveland one time, all the businesses on Euclid Avenue, some of them went out of business because they changed all the lane usage, and instead of having the buses run on the outside lanes like they traditionally did, they put it down the middle, and they took several years to really revamp all of Euclid Avenue. And because of that, some businesses couldn't survive because they stopped having traffic. So there could be things that you might not even think of that could really impact your investment in that real estate. And again, real estate decisions should fit your total portfolio, your estate plan, your tax plan. So you don't want to do this in isolation. Again, some people think owning real estate's very sexy, and it might be for them, but you need to take the emotion out. You need to look at the brass tacks. You need to understand, cash flow, debt service, all the stress testing we talked about. You want to make sure you're putting good money into a good investment so that you're rewarded appropriately. So at the end of the day, the best returns in real estate usually don't come from timing the market. They come from being knowledgeable, doing your research ahead of time, being disciplined and intentional about how each property fits your biggest picture. So thanks again for tuning in to another episode of Frank Wealth Insights. If you're wondering what type of investments in real estate fit your portfolio, how to evaluate the risks of real estate or different types of real estate, how financing and taxes can impact your returns, please reach out to your team at Return on Life Wealth Partners. We're here to help. Just give us a call at 440-740-0130, or you can visit us at returnonlifewealth.com to connect with us. And please, if you like what you're hearing from us, please subscribe to Frank Wealth Insights on your favorite podcast platform. Pass our information on to others that you feel would benefit from learning from the topics we like to talk about. And don't forget to like and subscribe to Frank Wealth Insights on your favorite podcast platform. And if you found today's discussion valuable, please share with a friend. Until next time, here's the thoughtful planning, diversified portfolios, and most importantly, living a life well lived. Thank you.